Don Kaufman here, doing the weekend update for TheoTrade, June 27th, 2020. Are we starting to see a second wave of selling inside of the broader markets? We're going to look at that much more in detail. It is critical to understand the forward look of this next week of trade, and we're going to do just that. First and foremost, a little bit of recap and some of the action of last week. One of the first things I want to really kick this off with is ranges are just absolutely rocking inside of the S&Ps, including, of course, overnight trade, Nasdaq as well. But when I'm talking about with ranges are rocking, let's just zoom in. I mean, listen, you got 5 trading sessions where you're seeing in many of those trading sessions ranges in excess, again, in excess of like 100-point plus moves in the S&Ps. Listen, I just don't think that traders are giving nearly enough credit to the sheer magnitude of some of these ranges. Now, granted, not everybody that tunes in to TheoTrade, one of the weekend updates or the daily updates, all right, not everybody necessarily is in tune with the S&P futures, but the S&P futures, again, they drive order flow, and some of the moves are absolutely occurring overnight. Nevertheless, you know, if you just look at like Friday's high to low, you have a 90-point move. I mean, again, we're seeing consistent ranges, 100-point ranges, 90-point ranges. Your smallest range here, oh, but still my heart. We only had, what, a 75, 80-point range, you know, on Thursday's trade. And it's, again, this is a critical sign. I think that, again, that's being missed by most traders. Whether you're trading intraday or whether you're positioning yourself, the market's actually throwing off huge volatility signs over here, which is exactly my next topic is Volatility Speaks. Before I get into Volatility Speaks, though, I also want to reiterate some of the wild ranges that you've seen in the Nasdaq. Listen, this is just, you know, kind of on the peripheral that I'm displaying some of the ranges. The Nasdaq is, again, the NQ is a 10,000 dollar product, and it is continually throwing off 200, 300 point ranges on a day-to-day basis. People, I'm telling you, do not overlook those ranges. And the reason I'm stating that is, you're throwing off 5, 6, 7 days in a row a 2-point or 200-point range. Even I'm having a tough time with that. You're throwing off this 200-point range. What's not to say, you're going to get an outside move there where you get 2 or 3 deviations. I think you can fully anticipate, and this is where I'm going with this. I think you can fully anticipate, 500, 600 point moves inside of the Nasdaq before some of these ranges start to die down. And that's even with, we're coming into a holiday trading week. I'm going to discuss that momentarily here as well. Even with the holiday trading week, listen, July 4th is coming. At this point, it's not going to make any difference in terms of dampening down volatility. Not like anybody's going anywhere right now. So again, expect wild ranges to persist in the marketplace. I wanted to kick off with that because I just don't want you to get caught in some of what I would interpret as hideous crossfire that is about to happen inside of the broader marketplace. You look at the S&Ps, they throw off, 90, 100-point ranges. You get an outside day. An outside day is going to look like 200, 300 points in the S&Ps. Yeah, that's right. Put on your big boy pants. The next thing that I want to describe over here before we go too deep into any analysis of the marketplace is Volatility Speaks. And I'm actually a little bit surprised by this, and I'm going to take you into detail because this can actually help you with, you're a little bullish in the marketplace, you're a little bearish in the marketplace. So we're going to look at a number of the different volatility products to kind of kick off, again, this weekend's update. We warn you a little bit about some of the ranges. But the point that I want to make, what volatility is actually telling us, here I'm looking specifically at Volatility Futures. Now, not everybody that tunes in, again, is a geek and looks at, Volatility Futures. The point that I want to make with the Volatility Futures, because they really do speak to you, you have to look at like the active vol contract, which is roughly, and I'll just put it down here, 34.45. Then I want you to look at the next contract out that actually trades volume. So you have a contract here that trades volume. The next contract out that trades volume, of course, is going to be August. And that one's sitting roughly at the same thing. It's about 34.35. 0.38. And the reason I'm like, I'm a little surprised by that, and you go out to September, bumps right up to like 34.17. When I say volatility speaks, what I'm showing you here, some people, there's contango, there's backwardation. Right now, the volatility is completely and utterly flat. And we're just at a definitive kind of like, inflection point in the marketplace where volatility right now is saying, is this bullish or bearish? Okay, this volatility right now couldn't be any more neutral, okay, to the tune of the marketplace, meaning that we could explode higher, we could explode lower. Listen, you can't discount the fact that these volatility numbers are incredibly high. Whether it's July, whether it's, Augie, whether you're looking at, SEP, those volatility levels are incredibly high. But I would have anticipated with some sell-side activity that occurred on Friday, and the S&Ps are down another 2%, neither here nor there. I mean, for the most part, everything that happened this week pretty much came down to Friday. There's sell-side activity. So what? We're down another 2%. I mean, the week net, not hideous. The S&P fell 3.3%, and the Nasdaq just edged lower, maybe 2.9%. Nothing too hideous on the week. Again, most of the sell side activity persisted specifically into Friday. So these volatility futures being flat over here are still denoting, this is anybody's marketplace. And we've come to kind of a key inflection point. Now, if you look at other indicators, like, listen, the VIX is not telling you anything. The exact same thing as the vol futures. I will give you one little tip, though, over here. If you look at the VVIX, I mean, we're still trading out here in Never Neverland, which is roughly, 128, 130, right in here above 110. That's kind of your critical level, and I can't stress this enough when I bring up the VVIX. So the VVIX, for those of you that are a little newer, it's the volatility index. And if you look back at the history, there's only a history of the VVIX till about 2012. So I'll bring up the full Monty in here. We'll bring up a time frame. We'll knock this out as long as you can possibly go. But we're in a higher VVIX period right now, sustained higher than in any other point since the VVIX has been tracked. So I looked at things like VVIX all the way back in like 2008, and we're now at a sustained VVIX above roughly 110 for more consecutive weeks than we were back in 08. The reason that I elaborate upon the VVIX, what this basically is it's traders that are typically like institutions and so forth, they may hedge using the VIX. What drives the VVIX? It's the volatility of the VIX. I mean, the VIX is the volatility of the SPX. So if you look at the SPX and you look at its options, because it only has options, that would be the VIX, right? And it's giving you a measurement of like 30-day vol in the SPX. Well, the VVIX is the 30-day vol of the VIX itself. And the interesting thing is professionals used to go to the SPX to hedge, but a lot of professionals now, they actually use the VIX options to hedge, which drives the VVIX. So what the VVIX in effect is telling you is, holy crap, we're in Never Neverland. I mean, there's traders out there and they're paying 130% volatility. That's what they're paying to hedge their portfolios, which indicates there's still a tremendous amount of risk in the marketplace. I don't want to say sell-side activity, but there's absolutely tremendous risk in the marketplace, and you cannot overlook what that VVIX is saying. Above 110 is what we call the VAMA zone. By the way, VAMA is also kind of indicates volatility of the volatility, and when you're above 110, yeah, it's serious out there. We drop below it for a brief and fleeting moment, but up in the 130 like level, again, it's Never Neverland out there. So volatility, speaking volume, still highly elevated, but in the shorter duration, the volatility here is completely and totally uncertain as to market indications, and we're going to keep a very close eye on that, and I'll talk about more of the implications of volatility as we move forward through the week. On Monday, we'll probably have again a better feel for what these vol futures are going to look like. All right, the next aspect I want to bring to your attention, I think this is going to be of huge assistance in this next week of trade. If we take a look over at the SPX, so the SPX closed just north of the 3,000 level. And maybe it's a critical level. I don't necessarily put too much weight into the 3,000 level other than the psychology of it. We'll come back a little bit to levels here a bit later, but What I do want to point out, and this is it's entertaining, people. If you miss this, you're missing it all. Let me close up this left side bar. The SPX is going to offer this week weekly expirations, okay? But they're every single what? They're every single day. And you're like, wait, what? How is that possible? So in the SPX, we typically have a Monday expiration. Well, of course, we have a Monday expiration, okay? But then you have to have an end of June expiration because there's quarterly expirations as well. So you've got an expiration coming on Monday. You've got the quarterly, which is it's the end of the inning. It's the end of the quarter, which is obviously coming on Tuesday. Then we have a Wednesday expiration, which is standard because the SPX always has a Monday, Wednesday, and a Friday. But this coming week, oh no, there is no Friday. So we're going to have a Thursday expiration. Now, why do I even spend more than 2 seconds mentioning this? And I'll tell you why it's worthwhile to spend time on this, because it's actually going to give you a pulse on volatility every single day. Like this is like a daily VIX. You're seeing like the Monday volatility, the Tuesday volatility, the Wednesday volatility, the Thursday volatility. It is phenomenal. It's phenomenal. I'm going to be talking about this all throughout the course of the week because you got your finger right on the pulse of the marketplace. If the marketplace is going to display any degree of risk at all on Monday, it's going to wear it like a badge of honor on the Monday expiration. Same of Tuesday and Wednesday. I mean, you have literally an intraday VIX, and there's just most people just don't get it. They just don't get it, and it frustrates me because this is the kind of stuff that you need to get, especially if you trade on an intraday basis. I mean, the SPX, the mother of all products, is going to drive order flow to a huge amount of the marketplace, and you can actually see the progression. And I'm going to tell you the exact progression, and why I'm spending so much time on it is simply because if you look at those 4 expirations, what's the progression for the week? I'll tell you exactly the progression. Monday, we're not really expecting a whole lot, and as Tuesday comes, that volatility is picking up. Something's going on over here. On Wednesday, there's a little bit more volatility edging in on Wednesday. Oh, look at the calendar because there's FOMC minutes. And then by Thursday, wow, that's a real spike up in volatility on Thursday. Yeah, it's because we have jobs numbers. Yeah, the employment situation's coming out, and the again, how many employment situations could you possibly have come out at one time? Well, interestingly enough, on Thursday, you're going to have multiple employment situations coming out at the same time. You're going to have initial jobless claims stacked with employment, the monthly employment, all at the exact same moment. Oh, that should be fun. And you can see it actually inside of the volatility. I mean, volatility, it speaks volumes out there as well. So that's why I wanted to tie in together the SPX options having daily expirations this week. They're weekly expirations, but they're daily. Okay, now let's get down to business. Let's get down to business of what's going on inside of the broader markets. Okay, because what we're starting to see is, again, some big-time sector rotations. Obviously, we got some play to the downside inside of the Nasdaq this week. We got, again, huge ranges in here. But sector rotations and expected moves. One of the first things that I wanted to note, and we'll come back to this calendar here, is we saw full-blown correlation properties several times this week. I mean, we went literally from like 50-50 advanced decline lines to the very next day, full-blown correlation. There's absolutely unequivocally nowhere to hide. But when I start talking about sector rotations, okay, what I want you to think about in here is like the different sectors. There's sectors and industries, okay, but I break this down very, very differently. So here's the S&P 500 sectors. All right, I break this down very differently. I don't necessarily want to eyeball the sectors other than, on an intraday level. What I want to show you, okay, in terms of some of the sectors, okay, is we're going to actually go explore a few of these sectors on the chart, and we're going to apply, okay, auto expected moves. So to begin with, I want you to take a look at, a major sector that's been in play lately, of course, has been the financials. And we're going to kick this off with a little discussion of the financials and kind of move forward from there. What's critical to understand about this marketplace, okay, at this point in time, okay, it doesn't matter, okay, per se, whether you're bullish or bearish, because that's usually what, we're going up, we're going down. Okay, all right. It's not going to make that much of a difference. What's important, again, is to know if we're going up, okay, what's going to lead us up, and if we're going to go down, what is going to be the driving force behind the down move. And sector rotations helps you understand that. And you're like, I don't get it. Well, get this, okay? Here are the financials. Now, I'm going to broaden out your look at the financials before I go too in depth. Here are your financials on a year-to-date basis. And why does that matter? I'll show you exactly why it matters. Okay, year-to-date basis, the financials are off roughly by what? 27%. I mean, that's bad. It's really bad. And I was talking about this the other day in a video. Then you look over at something like XLE, the energy sector, it's down 40%. Compare that to the QQQ, okay? And the Qs are actually up 11%. So now I want you to see, all right, on, again, a little bit of a different level, I want you to look at the auto expected moves with me. So you know that the financials have been beaten, okay, and bludgeoned. They've been hit hard. Okay, if the marketplace is going to sell off and sell off hard, the financials, they look apparently like they had a very, very rough week. Why? Well, you know, the stress test came out. They didn't do so well. On Friday, they broke to the low side of the expected move. Now, there's a trade right there. What's the trade? The financials have been breaking down ever since they clipped the 2650 level. They've been breaking down considerably. If the marketplace is going to bounce higher, I don't care what you think. I'm telling you, if the marketplace is going to bounce higher, right, the financials will explode back onto the scene. You're like, but what about the Nasdaq? Yeah, the Nasdaq will play. But the financials, okay, are going to actually be leading the S&Ps if we were to bounce back to the upside. And again, I don't care what your, but my directional bias, get rid of your bias. If you're going to explode back to the upside, I think you should probably have one of these in play. This is actually a back spread, okay? So on back spread inside those financials, if we're to explode back to the upside, okay, great. But here's the cool thing about the back spread. The back spread is being done for a very, very small credit. So if we explode back to the upside, gold, Jerry, gold. We continue to sell off. Well, it is what it is, but I'm going to keep that 14-cent credit. And that's again, this is how you need to trade right now. Because I'm telling you, and the reason I set you up for this a little bit, the volatility right now is completely what? I don't know which way we're going to go. I'm feeling very uneasy right now. So it's critical to understand the sector rotations. So if we're going to be bouncing back to the upside, the financials are going to rip. Okay. Next to that, along with the financials, all right, I think you should look probably at IWM. IWM, the Russell. Okay. The Russell year-to-date basis is off 17%. But if we actually start to apply, if you will, a little bit of expected move, okay, the Russell didn't absolutely get hammered this week, but definitely towards the lower end. So why didn't I do the bullish trade inside of the IWM? Because I believe at this point, I really do. I believe at this point the financials, having broken through the bottom of the expected move, are the appropriate place to be. Then, of course, we're going to look at the QQQ. Now, the interesting thing about the Nasdaq, all right, and again, I just showed you on the Nasdaq a moment ago, percentage year-to-date up 11%. On the Nasdaq, and I apologize here, let's cruise over to auto expected moves. The Nasdaq also came down a little bit, but I mean, the Nasdaq actually tagged the upper edge of the expected move, came down. All right, great. Here's the thing about the Nasdaq, and I said, if the market's going to explode higher, it's actually going to do it on the back of the financials. If the market's going to take off lower, you can expect it's going to be the Qs. You better expect it's going to be the Qs, because if you look at this from a sector standpoint, and I cannot stress this enough, and I've been stressing this day in and day out, right? From a sector standpoint, the Nasdaq's still up like 11%. If the marketplace as a whole, that is the S&Ps, were to sell off, what else could bring it down? All right. I mean, listen, you can go into all the sectors. You're like, what about consumer staples? Consumer staples, great. It's already down, 8-9% year. What about, we already showed you energy. Energy's down like 40%. Okay. You're not going to squeeze blood from a turnip over here. What else you got? You go, what about healthcare? XLV. All right. Bring up, okay. Well, it's already down 4%. You got to put all the weight inside of the QQQ. So if you're gonna bear up in any way, shape, or form, it's the Nasdaq where you want to get bared up in. Okay, and I think you should actually consider possibly a back spread in something like the XLF, all right? And if you're going to take your bearish position, maybe do a bearish position inside of the Qs. Now, I've got a lot of different bearish positions inside of the Qs, but I have one that maybe you guys will find. This one's a little cutesy. For those of you that understand a little bit about skew, I sell an out-of-the-money call spread to finance the purchase, okay, of an out-of-the-money put spread, and it's actually done for a fairly substantial credit. If you're kind of curious about this one, I'll cruise over to my account statement, and again, I'll just show you what the orders happen to look like, and I fired off a lot of these, but those are what the orders happen to look like. Again, I'm selling a call spread to finance the purchase of the put spread. The call spread I'm selling is $5 wide. The put spread that I'm purchasing is also $5 wide. Okay, and they were equidistant at the time, but I was able to do it for a 53-cent credit. So, if we rallied huge, I would probably take a little bit of a hit here in the QQQ call spread. But if I take a hit in the QQQ call spread, what am I doing? Covering myself with the XLF. Better know about sector rotations, expected moves. I'm telling you, that's how you trade these markets, because otherwise you're just going to get run over. Big tech, of course, is still outperforming, and that's why I wanted to cover it. When I say big tech, now I'm actually referencing the monsters of tech. But as I was saying, we're throwing off some big ranges. Take a look. Again, this is a conglomerate symbol. Take a look at the volume. Take a look at the range. Okay, big tech could actually be in big trouble over here. Now, big tech, though, took a big hit, most appropriately because of Facebook. So I happen to carry a short position in Facebook. Facebook is rocking. I think it's important Facebook broke through the 220 level. If you are a levels kind of person, again, I'm not a big chart guy. I'm a much more quantitative trader. It's why I talk about sector rotations and appropriate logic for positioning yourself. But in Facebook, I don't mind saying this. I'm outright short. I don't think they have a fundamental leg to stand on. Now, the Facebook sell-side activity was about, this company's boycotting them, and then Verizon stepped in. Verizon's a big boy company. First, it was like Ben and Jerry's ice cream, right? All of a sudden, you're like, Verizon. You're like, okay, I'll listen to Verizon. Anyway, big sell-side activity in here has to do with the boycott policies. Of course, Facebook is going to pat everybody on the head and make this okay, but it might be too late. And this thing could see some extraordinary sell-side activity. I'm going to remain short inside of Facebook, but Facebook, of course, led a lot of the big tech to the downside. But I can't stress enough. Again, market's going to fall. It's got to be done on the back of big tech. So you look at whatever's strong in the marketplace here. Something like Microsoft. Microsoft still rather, unimpeded at this point in time. Another point I want to make, and this is more of a fundamental, take, and it has a lot to do with Nike. Okay, Nike, their earnings came out and they just bombed. There's nothing nice to say about it. The earnings were down. It was minus 38%. That's it. The stock was relatively unimpeded. I just can't. This one, it's not that I can't get over it. It's just, again, Nike is still a hop, skip and a jump away from, no pun intended, maybe a little bit. But they're literally just off their all-time high inside of Nike. I wanted to bring you to a much more substantial time frame. And they clearly, in this earnings announcement, indicated that they were, for the most part, bleeding out. They said they'd be fine. Okay, the reason the marketplace loved it is because their online sales, I think, picked up like 75%. Listen, you can make every argument you want. Pretty shocked that Nike held up as well. But Nike, for me, all right, holds a lot of hope for Lululemon. I remain short inside of Lululemon. And again, this is not a short-term position. This is long-term, if you will. I'm short, but it's an investment to the downside. Lululemon trading just shy of the 300 marker. The thing I was surprised about, and the reason I'm bringing it up, is that Lulu was not more negatively impacted by the Nike, earnings announcement. Again, the fact that Nike is just a hop, skip, and a jump away from that all-time high just shocks me. It really is. You start to realize how, and the kind of the reason I threw this into the weekend update, okay, the marketplace right now clearly isn't running on any fundamentals. The marketplace right now isn't functioning on anything, I believe, other than a quantitative trade. And you could say, it's the Fed. Well, the Fed actually plays into the quantitative trade. But the bottom line is there are going to be some phenomenal setups coming. I mean, they're there right now. Stuff like short LULU. It's just you're going to have to sustain some short-term pain. All right, onward and upward. We come to the SPX, the mother of all products. The SPX had some pretty substantial movement in recent, again, trading sessions. But most appropriately, the big move, of course, came on Friday. We almost tagged down to the lower edge of the expected move. Almost got there. The reason I'm emphasizing the lower edge of the expected move, that's because Don had a butterfly laying right on 29.85. I missed. Don't worry, I only paid 25 cents for the butterfly. So let that one fly here a little bit. Right down to the lower edge. This next week of trade. Now, again, I want to reiterate, the next week of trade is only going to be a 4-day trading week. 4-day trading week. We have precisely $101 of expected move. The previous week was $112 of expected move. So again, keep your helmets on. This is going to be a fairly wild week. The next thing is the forward look. Okay, this week, know your calendar. It's not often that I mention this, but you better know your calendar. You do have FOMC minutes coming out. I don't think anybody really anticipates anything out of the FOMC minutes. Okay, but they're going to be firing out. Again, there's so much economic data landing in what's a holiday week, and the mother of all economic data lands literally on Thursday morning. Again, the irony of the Thursday morning is you have the employment situation with jobless claims at the exact same time. A couple of note offerings. It's a party, people. That's why the volatility picks up considerably in the SPX later in the week. The next thing, watch those wild ranges. Can't stress this enough. It doesn't look like that much on a chart. It really doesn't. But the S&Ps, okay, the S&Ps, including some of the overnight trade, I can't stress to you enough. Throwing off ranges this big. Where's the outlier? Well, it could be something like that. You're going to have possibly 2, even 300-point moves in the S&Ps. I wouldn't be surprised in the next 2 to 3 weeks to see 600-point plus moves fly off inside of the Nasdaq. Again, this is not that big of a move. A little bit of damage was done inside of the broader Nasdaq, but it's negligible. Look for wild ranges to persist over here. Last but definitely not least, gravity points are back in play. Okay, in positioning yourself, if we are to actually crest down to 29.83, and frankly speaking, with everything that's going on here, there's a little bit of a scare. I would kind of assume that maybe even on like Sunday night when the markets reopen, again, Sunday night when the markets reopen, we may just tag right down to 29.83. These gravity points hold huge weight. If we start hitting the gravity points, look for us to ping back and forth. Again, that would actually be some wild and expansive ranges right there. Just because this is a holiday week, okay, we very well could see a kind of a second wave of sell-side activity. My bias does not lie bullish or bearish, okay, in the short term. In the short term, as you saw, okay, in the QQQ, I'm taking the bearish position. Inside of the financials, I've got the big bullish position. They're kind of offsetting one another. But again, we're ready to rock here inside of the marketplace. Be aware of it. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.